HMRC made an announcement on the 23rd of June 2026 that almost nobody is talking about. Not because it was buried, not because it was technical, because it was published the same week as a series of other announcements, landed quietly in the tax press, and was never translated into plain English for the people it affects most. Inside that announcement is a change that will affect how and when money leaves the bank accounts of millions of UK taxpayers, potentially from as early as 2029. And buried alongside it are three other policy shifts that are already active, already affecting people, and generating consequences right now for those who have not yet responded to them. My name is Frank. Welcome back to HMRC Update. Today, I want to pull back the curtain on what HMRC actually said in June 2026 and what it means in practice, because the gap between what was published and what most taxpayers have been told about it is significant, and the deadlines attached to these changes are already passing. If you are not subscribed to HMRC Update, please do that now and hit the bell. This channel exists precisely for moments like this, when HMRC moves quietly and the people most affected find out too late. Subscribe. Let us get into it. The first hidden change, the one I want to spend the most time on because it is both the most significant and the most misunderstood, is the Making Tax Digital August 7th deadline that around 864,000 taxpayers in the UK are facing for the first time this week. Making Tax Digital is being phased in by HMRC, and a key change means that those who do their own tax returns now have to do quarterly submissions. Those with a turnover over £50,000 in the 2024 to 2025 tax year should be using MTD as of April 6, 2026. Here is what makes this a hidden change in the truest sense. The obligation began on the 6th of April 2026. The first quarterly submission deadline, the 7th of August 2026, is upon us right now. And yet, as of May 2026, HMRC confirmed that as of May 20, 2026, 314,042 users had signed up to Making Tax Digital for income tax, with approximately 282,637 of those being in the mandated cohort, those with qualifying income over £50,000. Do the mathematics. HMRC estimates approximately 864,000 people are in the mandated cohort for April 2026. Fewer than 283,000 had signed up by May. That means somewhere in the region of 580,000 people who are legally required to be filing quarterly digital updates right now and who were supposed to file their first update by the 7th of August 2026 have not yet registered for the system they are already supposed to be using. HMRC has said thousands of customers are signing up for Making Tax Digital every week, in line with their expectations, and they expect further increases ahead of the August 7th deadline. They have written to millions of customers and delivered hundreds of events and webinars. But here is the thing. Receiving a letter from HMRC does not automatically translate into action, particularly when the letter describes a system, compatible software, quarterly updates, end-of-period statements, final declarations, that requires meaningful setup time, software selection, and a complete change in how financial records are maintained. Taxpayers will no longer be able to file using HMRC's self-assessment portal. Anyone who is eligible for MTD for income tax should register for it now. If you are a sole trader, a landlord, or have combined gross income from self-employment and property that exceeded £50,000 in the 2024 to 2025 tax year, and you are reading this having not yet registered, the 7th of August deadline has already arrived. The practical question is what to do now. Although HMRC will not issue penalties for missing a quarterly update during the first year, delaying it could create a bigger administrative and financial headache later. Taxpayers must still submit the outstanding updates before they can complete their annual tax return. So allowing them to build up risks turning a manageable quarterly task into a last-minute scramble. The absence of a financial penalty in year one does not mean the obligation does not exist. It means HMRC has acknowledged the scale of the transition and built in a grace period on the penalty. The underlying requirement to register, select software, maintain digital records, and submit quarterly updates is mandatory. The longer registration is delayed, the more outstanding updates accumulate, and all of them must be submitted before the final declaration at the 31st of January 2028. The rule changes are being phased in year by year. Those who had a turnover of more than £30,000 in the 2025 to 2026 tax year will need to use MTD from April 6, 2027. Those who are over £20,000 in the 2026 to 2027 tax year will need to use it from April 6, 2028. If you are currently below the £50,000 threshold, the direction of travel is unambiguous. The system is heading toward you. The businesses and sole traders who are not yet in scope have until April 2027 at £30,000 and April 2028 at £20,000. That is not a distant horizon. That is 1 or 2 tax years away. The correct response to being just below a threshold is not to wait until you cross it. It is to understand the system now while there is no deadline pressure, select software at your own pace, and be ready when the obligation lands rather than discovering it after. Drop a comment below if you are a sole trader or landlord who only just realized the August 7th deadline was this week. You are not alone, and the number of people in that position is, as the registration data confirms, very large. Back to the second hidden change. The second thing HMRC confirmed on the 23rd of June 2026 is the one that will affect how and when tax money leaves your account, not this month, but in a direction that every self-assessment taxpayer needs to understand now while the consultation is still open. One of the most
significant proposals is a consultation on timely payments for self-assessment taxpayers. The government is exploring ways to collect tax throughout the year rather than relying on the large payments typically due each January and July. For taxpayers with both PAYE income and self-assessment income, this could mean more of their tax liability being collected through PAYE from April 2029. HMRC is also considering wider changes to the payments on account regime for other self-assessment taxpayers. Under the proposal, taxpayers would pay their forecast tax liability during the tax year, with any balancing payment or repayment calculated once their final tax position is confirmed on 31st January following the end of the tax year. For many sole traders and landlords, spreading tax payments across the year could make budgeting easier and reduce the impact of large tax bills. However, it could also mean paying tax sooner, making cash flow planning even more important. Here is what this means in real terms. Currently, if you are self-employed with a significant January tax bill, you have the period between earning that income and the January deadline to hold the cash, earn interest on it, and deploy it in your business. Under the timely payments proposal, that window shrinks or disappears entirely. Tax would be collected closer to when it is earned, quarterly or through PAY adjustments, removing the cash flow that many small businesses currently rely on to manage seasonal income fluctuations. The consultation closed on the 4th of August 2026 for public responses. What follows the consultation is a government response, likely followed by legislation. The April 2029 date for PAYE and self-assessment interaction gives some runway, but the direction is set. If you are a sole trader or landlord who currently manages cash flow around the January and July payment on account cycle, the way you plan your business finances will need to change before 2029. The third hidden change from the June 2026 announcement is the one with the most direct, immediate enforcement implication, and the consultation window for it is closing on the 28th of August 2026. The proposals would enable HMRC to collect debts directly from taxpayers' accounts in regular installments, supported by a comprehensive suite of safeguards to ensure the power is used fairly and proportionately. The consultation closes on 28 August 2026. Currently, HMRC recovers outstanding tax debts primarily through tax code adjustments, reducing your personal allowance so more tax is taken from your wages or pension, or through time-to-pay arrangements that the taxpayer must proactively set up. What is being proposed is a new power to initiate regular installment collections directly from bank accounts without requiring the taxpayer to request it first. The safeguards in the proposal include minimum balance protections and a right to challenge before collection begins. But the shift in the dynamic is significant. Today, recovering a tax debt requires HMRC to negotiate with the taxpayer or adjust a tax code. Under the proposal, HMRC could initiate direct bank account collections. The power is new. The direction of enforcement is more direct. And the consultation window for public input closes on the 28th of August 2026, which means if you have a view on how this power should be constrained, the time to express it is now at gov.uk. The practical implication for anyone with an outstanding HMRC debt right now is identical to what it has always been, but more urgent given this direction of travel. Contacting HMRC on 0300 200 3822 and setting up a time-to-pay arrangement on terms you negotiate gives you more control over timing and amounts than an automated collection process that HMRC initiates unilaterally. A voluntary arrangement made now is a better position than a direct bank collection initiated later, under powers that do not yet exist, but are being consulted on today. The fourth hidden change is the one that Blick-Rothenberg warned about in their published analysis, describing it as a covert measure in the tax system designed to increase government tax takings by tinkering with thresholds and reliefs without making headline announcements. From July 2026, a new Advanced Tax Certainty service will offer binding clarity on tax rules for major UK investment projects. This service, covering corporation tax, VAT, stamp taxes, PAYE, and the construction industry scheme, targets new UK investments exceeding £1 billion, providing predictability for significant ventures. That is a change for large investors, not the focus of this channel. What matters for everyday UK taxpayers is the covert mechanism that sits alongside it. The personal allowance remains frozen at £12,570 until April 2031. The higher rate threshold remains frozen. The national insurance thresholds remain frozen. None of those are new announcements. But every April in which wages rise while thresholds stay still, a larger proportion of each pay rise falls into a tax band it previously sat below. This year will see the government intensify its drive to close the tax gap. Expect new measures, including increased late filing penalties and in some cases an expansion of HMRC's powers, signaling a tougher stance on compliance. The combination of frozen thresholds pulling more income into taxable bands and HMRC increasing its enforcement activity around late filing and undeclared income creates a specific risk profile for taxpayers who have not reviewed their position recently. The risk is not dramatic, it is gradual. It is the kind of change that does not appear as a single headline, but that accumulates quietly across multiple tax years until the effect on a household budget is material. The correct response is not alarm. It is an annual review of your tax code, your national insurance record, your savings interest position, and whether any income source has crossed a
threshold that triggers a new obligation. The personal tax account at gov.uk is the fastest way to do all of that in one place. 20 minutes once a year is the difference between catching a wrong code early and discovering it has been running for 3 years. HMRC is also reviewing its benchmark scale rates and overseas scale rates, the flat rate allowances businesses can use to reimburse employees for meals, accommodation, and travel expenses without checking every receipt. The government says the review will consider whether current rates still reflect actual costs and whether the system can be simplified. For anyone claiming business expenses, self-employed or employed, a review of your claimed rates against the current approved figures is a sensible precaution in any year when HMRC is actively scrutinizing that relief. So here is the complete picture of what HMRC confirmed in June 2026 that most people have not yet been told. 864,000 taxpayers face the Making Tax Digital quarterly submission deadline from August 7, 2026. Those with gross income from self-employment and property above £50,000 in 2024 to 2025 are already in scope. If you have not yet registered, register now through your HMRC online account and select compatible software from the approved list at gov.uk. There are no financial penalties on quarterly submissions in year 1, but all outstanding updates must be submitted before the final declaration deadline of the 31st of January 2028. The Timely Payments consultation proposes collecting self-assessment tax throughout the year rather than in January and July lump sums, with PAYE integration from April 2029 and wider reforms to the payments on account regime under consideration. If you are a sole trader or landlord who relies on the current payment calendar for cash flow planning, now is the time to begin adapting your financial model. The debt collection consultation, which would give HMRC new powers to collect tax debts directly from bank accounts in regular installments, closes on the 28th of August 2026. If you have outstanding tax debt, set up a time to pay arrangement now on 0300 200 3822 before enforcement mechanisms become more direct. And the frozen threshold picture continues to pull more UK taxpayers into higher tax bands every April without a single new announcement. Review your personal tax account at gov.uk annually. Check your tax code. Check your national insurance record. Know your savings interest position. Know your threshold exposure. The taxpayers who are surprised by HMRC letters and adjustments are, in the main, the ones who have not looked at these numbers in the last 12 months. HMRC made these announcements in plain sight on the 23rd of June 2026. The headline coverage they received was a fraction of what the content warranted. This channel exists to close that gap. Share this with someone who is self-employed, a landlord, or anyone who files a self-assessment return and has not yet heard about the Making Tax Digital August deadline. The number of people in scope who still do not know is, as HMRC's own registration data confirms, very large. Subscribe to HMRC Update if you are not already here. I will